When buying a property, should I put in a larger deposit or a smaller deposit?
This is a question a lot of first home buyers ask. Is it better to wait and put in a bigger deposit, try and get to your 20% deposit, or should you try and get in with a smaller deposit, 10%, 9 or 8%, a little deposit as you can to get into the market? In today's video, we're gonna break this down. We're gonna look at some of the benefits in getting into the market sooner with a smaller deposit and some of the negatives, including lender's mortgage insurance costs. We're gonna try and work out what's gonna be the best situation potentially for you and a lot of first home buyers out there. We're also gonna use some real case studies to help you decide based on a couple of properties that have sold and when people have tried to hold off and thought it was better to save a bigger deposit, what that actually looks like. So if you're trying to work out if you should buy with a big deposit or a smaller deposit, then keep watching.
All right, so we'll break this down into having a smaller deposit and what that looks like, the pros and cons, and then we'll look at a larger deposit, what that looks like, and the pros and cons. So starting off with a smaller deposit. Well, the first pro is that you get in the market faster. What that looks like is that you might actually be able to get some of that tailwind of the property market increasing and locking yourself in before it gets out of hand and potentially too expensive to enter the market.
I think one of the good benefits is that it potentially might give you another year or two to pay off your loan. Because the good thing when you do get a loan compared to renting is you're actually paying the place off progressively over the next potentially 30 years. And if you're in the lucky situation where you might be able to pay a little bit more than the minimum that you're meant to pay on your payments, you can actually knock off that loan quicker. So for example, you try and get in the market as soon as you can with a smaller deposit, you buy a place for say $500,000, assuming you borrowed the full amount. The minimum repayments, like you can see here, might be $486 a week. But if you can potentially get into the market earlier and pay an extra $100 a week, you're gonna be knocking your loan off 7 years faster and saving $69,000. And the same thing goes, if you can afford an extra $200 a week, you're paying off the loan quicker and you're actually saving time off your loan, getting into the market and potentially building equity from today.
So like Jaden said, using a smaller deposit, the advantage is you can get in the market faster. One of the disadvantages is with having a smaller deposit that you're going to need to pay extra fees. One of them is lender's mortgage insurance. Now this is a premium that you do need to pay if you have less than a 20% deposit. So in this case, where you have a smaller deposit, you might have 8 or 10% deposit, the mortgage insurance is going to be applicable. And it's worth noting the smaller deposit you have, the higher this premium is. So if you have a 15% deposit, your mortgage insurance is going to be cheaper than if you have a 10% deposit.
Let's have a look at a real life example of what this could be. And bear in mind, this is a pretty extreme example. Not a lot of first home buyers are going to be buying a $1.6 million property, but it illustrates the point of trying to catch a property as the property market is going up and getting some of the benefits of that increased value. So for the example, I'm going to use this 74 Fernberg Road property in Paddington. It looks like a nice old Queenslander. It was bought in 2020 for $1.6 million. And as you can see there, it resold less than a year later for $2.5 million. So what would it look like if you're a first home buyer trying to get into the market and putting down a 10% deposit versus a 20% deposit? So like you can see from the example, if you bought a place with a 10% deposit, you're going to need $165,000. You got the stamp duty, which is about $74,000 and $5,000 for solicitor fees and building and pests and that sort of stuff. So in total, you're going to need about $245,000 to make a 10% deposit work. On the other hand, if you kept saving, you're going to need almost double at $410,000 just to get into the property market. So that can take years and years to get in. So like we've said, potentially with a smaller deposit, the downside is paying lender's mortgage insurance, which is $50,000. It's a huge amount. The good thing is it can be added to the loan. So it doesn't actually affect your deposit figures below if you put a 10% deposit, etc. But when you're looking at buying a place, you might be thinking, wow, $50,000 of costs that I'm never gonna get back seems like a big amount. In this example, it worked out because like I said, the property, as it was verified, sold for $2.5 million a year later in October 2021. So that's an $850,000 windfall from holding that property for 12 months that you wouldn't have got if you'd had to save extra. And really putting in the less deposit meant that in this example, you could get into the market way quicker because you're only putting in $245,000 rather than saving for years and years and $410,000 with a 20% deposit.
So I guess in this example, the mortgage insurance is a pro and con. One, it's a negative because it's a cost to get in the market, but two, it's an opportunity cost where in that example Jaden shared with us, we actually might come out on top. Now, the other good thing with the lender's mortgage insurance, say as Jaden said in that example there, you've paid 50 grand. In the future, in 2 years' time, if you re-lend on the property and you lent back up to 90%, the mortgage insurance is actually credited with that same lender that you're with. So if the new mortgage insurance premium is $52,000, you'd only have to pay the difference between the 50 grand you paid and the new premium of 52,000, so the new premium would only be $2,000. So in some respects, the mortgage insurance might actually be good to have as you can continue to leverage the same property with the same lender in the future, having your mortgage insurance as a credit. So moving on to the next con with purchasing with a minimal deposit is that it can actually be harder to get your loan approved. Now, the main reason here is that when your loan approval goes through, there's typically different levels that the lenders look at. The first level is that the bank assesses your application and ticks off the valuation, and then in their final step, they need to get the loan approval through the lender's mortgage insurer. Some lenders have an ability to sign off on the mortgage insurance in-house. Some lenders actually send this off to a third party to assess your application. It's in here where your mortgage application can come into trouble because you're getting a few different parties assess your application. So having a minimal deposit can actually make it a little bit harder to get your loan approved because a third party such as a mortgage insurer is assessing your application, and the lenders can also be a little bit more critical when you have a lesser deposit because they see this as a high risk loan.
Also, a lot of banks are pricing for risk. So if you have a loan with mortgage insurance and you have less deposit, the banks consider you a riskier customer than someone with a 20%. In some cases, your bank will actually charge you a higher interest rate. Now, it depends on the bank how much this is. It might be 0.1, it might be 0.2%, but there generally is a difference because they see you as higher risk. So not only are you getting slapped with the lender's mortgage insurance premium, you might be paying a slightly higher interest rate than if you have a 20% deposit. And further to this point, if you have a lower deposit, you're then going to borrow more, so your payments are going to be more. So it's going to affect your cash flow. Let's look at the example from earlier. If you bought that place in Fernberg Road with a 10% deposit, your loan, including lender's mortgage insurance, is going to be about $1.53 million. So your weekly repayments go to almost $1,500 at $1,492 if you've got a 10% deposit. Now, if you put in a 20% deposit, because you're putting in more deposit, almost double like I said before, your repayments are going to be lower. So in this case, your repayments are only $1,284 a week versus $1,492. So it's going to make a difference to your cash flow if you're putting in less deposit because you're obviously borrowing more from the bank. Like I said earlier, you can play around with our extra repayment calculator to see if you made an extra $100 in weekly payments, what difference it makes. $400, you can cut years off your loan by doing that. So definitely have a check out on that because it's gonna affect your cash flow.
All right, let's move on to the pros and cons with having a larger deposit. Now, when we say larger deposit, we mean more than a 20% deposit. Now, the first and most obvious pro is when you purchase with the larger deposit, you avoid lender's mortgage insurance. So effectively, you can save thousands of dollars in lender's mortgage insurance for having a 20% deposit. And remembering that mortgage insurance is a premium that you pay for the privilege of getting a loan with less than a 20% deposit, and you're effectively covering the bank with their risk.
The other benefit is you're gonna have more equity if you put in a 20% deposit. So obviously you're putting in 20% deposit, so you've got 80% equity on a home compared to a 10% deposit with a 90% equity, but that lender's mortgage insurance does directly affect your equity because the $50,000 that you're lending for the lender's mortgage insurance gets added onto the loan, and it means in effect you've got a 90% plus LMI loan. So you actually have less equity available on your property when you get lender's mortgage insurance.
Another pro is it's easier to get your finances approved. For example, if you have more than a 20% deposit, a lot of the times they don't need to see any sort of employment history if you're full-time, part-time. If you're casual, they still want to see sort of 6 months. When you have less than a 20% deposit, the banks can sometimes ask to see 6 months employment history, or if you don't have that, 2 years employment in the same industry. So once again, the lending criteria becomes a lot easier when you have a larger deposit.
Yeah, in some cases, banks don't even want to see your deposit if you've got a 20%. They'll just take you on your word. You'll put on your assets and liabilities, I've totally got 400 grand sitting in the bank, and they'll just tick that off. They don't want to see it in an account. They don't care about genuine savings. It doesn't matter. In some cases, even the bigger banks don't even want to see your day-to-day statements. So if you have a bit of a binge on Uber Eats and you've got a 20% deposit, it's not going to matter. They're not going to ask for the statements. They're just going to get a declaration saying, yep, Nathan totally spent no money on Uber Eats, never gambles, he's a good boy, and here's the money. So that's another good advantage of putting in a 20% deposit.
And the last pro before we move into the cons is that you do get better interest rates when you have a larger deposit. So this makes it a little bit more attractive when you do have a larger deposit. You do get better deals with the banks. Okay, moving on to the cons and the detractors of having a larger deposit. I guess the first, as Jade mentioned in the earlier example, is it does take you more time to save that deposit. And it taking you more time, you actually might find the market will move on you and you can no longer afford in the areas that you are after when you started saving.
Another con can be for an investment property where you might want to maximize your gearing and taxation purposes is if you borrow less, there's obviously less costs and expenses to claim on your tax, which can go against you. So in a lot of cases with investors, depending on their cash flow strategy, obviously, they might want to gear up more on their investment and much less on their home because there's no tax benefits on that. So in some cases, being an investor, paying LMI isn't a bad thing because it means you potentially have to put less deposit in, you got more deposit for the next place, and you can build your portfolio much faster.
What do you think? Have you purchased a property and used a larger or smaller deposit? Leave a comment down below. Did you know here at Hunter Galloway, we get home loans approved. So if you're living in Australia and looking for a mortgage broker, we can help. There's no cost for our service, so hit us up at huntergalloway.com.au or call us on 1300 088 065 and we'll see you next time.